So thank you everybody for coming to this session. I know we all had questions about how the tax system, sorry, not tax, the credit system and credit facility system work in Canada. And all our questions are going to be answered today. So going to speak to us today is my senior colleague. His name is Olayinka Kindele. He's a seasoned financial advisor and a chartered accountant. So please write down all your questions and I'm sure he will do justice to it. So take it over there, Mr. Akin.
Thank you, Oka, for this wonderful time. Hi, everyone. As Oka has explained earlier on, I'm a financial advisor. I also a chartered accountant by background. Brief history for me is I moved to Canada I moved in 2015, but didn't stay. I moved back in 2019. I worked for a multinational in the US before coming to Canada. And when I moved to Canada, I worked in Obacon Construction. Now I'm a not-for-profit. I still work full-time and I'm a seasoned financial advisor, giving people financial advice generally. So Oka has said, invited me over today to talk about credits. And I know a lot of us either are new here or about coming into, some folks are just coming into the country, some are already landed. And moving into this country, it's a different ball game because what we are used to, basically, I think we are all Nigerians, right? Okay.
Yeah, almost everybody here is a Nigerian.
Okay.
We're posted on another platform where we have multi nationalities. So I don't know if any of them are.
Sounds good.
Yeah.
So a lot of us from where we are coming back home, we are not used to how the credit system works over here in Canada. But most times, I just have a few presentations. Let me just use that presentation to guide. Okay, can I share
I made a co-host so you can share.
Okay. Okay. I hope you can see my screen now.
Yes, we can.
Okay. Yeah, so I'll just give this session is just to briefly enlighten us on how the credit system works here in Canada. And basically the reason why it's so important for us to know about the credit system, because this is a very big tool in which most of everything here on the financial side of things work. Most times, sometimes you might not even be able to get a mortgage, you might not be able to get a house, you might not be able to get even sometimes some work are tied to credit. So, and some people always ask, why is it so? Why is there so much emphasis on the credit system here in Canada? And the reason why is because that's the only way the government can use to justify whether you are going to be able to pay your bills. They use the system to try and understand, or like a psychology, to understand how your behavior towards credit. You get, the whole economy here is dependent on credit. Everything is to the advantage of us here, because the way we get paid is not like bulk money, probably from where we are coming in. So most of Canadians cannot just afford to buy out houses directly, or to buy out cars directly, or to buy out large purchases directly. So we have to depend on the credit system to be able to afford a lot of things. So, and that's why there's a whole lot of regulation over this. And basically it leads us to what we talk about, the credit score. So this is basically how the government uses this is how most institutions. Come on, take the phone. Sorry, okay. So this is the credit score is like a 3-digit number, and it ranges from 300 to 900 basically, and it's how the government uses to determine how efficient you can handle the credit in the system. And it's also not just the government, a lot of financial institutions. As I said earlier on, even sometimes as you come into Canada, you find out a lot of newcomers cannot even rent houses. Why? Because one of the criteria some of the renters or some of the landlords always ask is, can I see your credit? And why are they asking that question? All because they want to know whether you've been able to meet all your expenses. So what are the things that goes into our credit score? Why do we have to use a credit score in this place in Canada, most especially even in North America, not just in Canada? Because if there's no, it's just like a rating system, it's just like a scale system. It is the only way that a lot of lenders can use to put you on the scale, whether I can have comfortability in giving you credits or giving you loans. Unlike in Nigeria, whereby most of our credits is tied to collaterals. Over here, sometimes the credits we collect some has collateral, some has no collateral. What level of confidence does these institutions have before they give you this credit? So that's why we need a credit score. That's why we need it. So almost everybody here has a credit score. So far you have a SIN number, you have a credit score. When you come into this country, the first thing first is when you open some banks, when you open your account, they'll also give you a credit card. That credit card enables you to start building your credit score. And it's very, very important Basically, there are 2 credit bureaus that the government recognizes that handles the credit score in Canada right here. And it's called Equifax and TransUnion Canada. These are private organizations. But what these organizations do is that they collect credit history from financial institutions, from lenders, from stores, from everywhere, even from anything that has to do with credit. And what they do is that they rank you based on a scale of between 300 to 900. And what affects those credit score? So it's very important to be able to maintain your credit score, because if I'm talking too fast, please let me know. And if there's questions, let me also know so that I don't just continue rushing.
No, your speed is fine. And if you have any questions, please put it in the chat. And at the end of the day, we'll tackle them.
Okay. So according to Equifax, a good credit score is usually between 660 to 724. Why? Because if you are within that range, then it gives them a level of confidence that, okay, you can be able to pay your debt. What does that, how do you build up your credit score? Most times when you come into this country, your credit score will either be on the fair side or on the good side. I have a little skill that shows how Equifax does this. So most times if you come into the country, it's either you're starting on the 500s or 580s you get. But as you have access to credit, your credit score improves. But there are a lot of factors that also affect the credit score you get. It's either it comes good or it comes bad. So it looks not just about repayment of your debts you get. It also looks at how long those debts you have maintained those credits. Why are they looking at that? Just to be able to understand, okay, if you want to collect a house and you're looking into a mortgage and the bank is going to give you 300,000, 400,000, 500,000, that's a lot of money. Even though the bank owns title to the house, but it doesn't mean they're still lending the money because the house is in your name. They need to understand how long have you been in the country? How long have you been able to maintain your credit history? How has been your history? Have you been paying back your debt? Have you been ensuring that, okay, that you maintain a good credit standing? And so that's why most institutions that you go to, they will always ask you, okay, I want to see your credit score. I want to see how your behavioral pattern has been in terms towards credit. You get to be able to guide them on whether they want to give you loans or whether they want to give you access to huge cash. A lot of people, most especially for the new ones coming in, we are not used to the credit system. I too, when I came in, I was also saying, oh, why would I collect a credit card? I believe I should just be paying my debts and this thing. But it doesn't work here because it has its advantages and its disadvantages. For some people, you get, when you come in, you need to, I'm not saying go around there and collect all the credits that is available, because it has put a lot of people into huge debts because they don't know how to manage those credits. But you need also those credits to be able to build your score, because if you don't have those credits, there's no way they can evaluate you. So just say, for example, you want to buy a car, there's always the option, do I finance it, or do I lease it, or do I buy it outrightly? Just for example. So the option of leasing, fine, doesn't affect your credit score because it's just as if you are renting the car. The option of financing it, meaning that you are paying a certain portion of the cost of the car, and then probably a financial institution is lending you out the remaining. That's a good credit because one, it's helping you to build your score. And most of the time, the money that you are using to finance is a fixed fee cost, meaning that you have a particular money that you're supposed to be paying back. Now, if you miss payments on those on that distance, it also affects your credit score. So a lot of questions has come in to ask, okay, how do I now determine what will boost my score? Or how do I determine what will reduce my score? You get? So there are many factors that can affect your credit score, a whole lot of factors. And as I said earlier on, one of there are major 5 factors that usually affect the credit score. One of them is your payment history. You get? If you don't meet your minimum payments on how much you are owing on your debt. So for example, there are different kinds of credits that you can access. There's mortgage, there's auto, there's line of credit, there's even your credit cards. You get, and all of them has a minimum set target of amount that you must be paying it to is either the interest amount or you are reducing the principal. You get. So if you miss any of those payments, it will drastically affect your credit score. You get. So most of the time, it's better to make sure that you set a reminder so that you don't miss any of your payments, even your bills sometimes. Because if you miss your bills, probably like your hydro bill or your energy bill or your gas bills, they can report you to the credit bureau that you have not been consistent in paying your debts or whatever. And this will drastically affect your credit score. You don't want any of these institutions to report you to the credit bureau. And the effect of that is that you won't have access to further credits, and it will tie you down over here in Canada. Another thing that can majorly affect the credit score is the amount you owe. So most of the thing, there's something we call the debt to owe ratio here. So for example, let's say you have a line of credit. For those who don't know, a line of credit is just similar to just collecting a loan from the bank. Some of them are collateralized, some of them are not collateralized. So if you collect a line of credits, they'll give you a standard limit. It might be 5,000, it might be 10,000, it might be 100,000. And if you have a mortgage, maybe it's 300,000, you have car loans, it's 20,000, and you have several credit cards, you get. So all what you need to do is that you need to total how much you are owing and how much facility do you have. For like mortgage and auto loan, those are recurrent credits, which by you are just paying standard how much I say. But for like all the other loans that has a limit, the weight of how much you owe is very, very key. Some people have 10,000 credit limits on their credit cards, and they've used up 8,000 or 9,000. By the time your rating comes out, that will drastically affect your credit score, meaning that you're not managing those debts well. Fine, if you have 8,000 and you pay off your 8,000 and you collect 8,000 the next month, is okay. But your debt to ratio will also, so for example, if you want to collect a house, a lot of what the banks will do is to assess how much you are owing. You get, even though you've met the down payment and you've met all requirements, they might put a condition on your mortgage that say, okay, before we can give you this loan, you must clear out all these credits. And why they are doing that is because they know that for you to be able to service your mortgage loan, they would have looked at your total income and comfortable that, okay, if you are still servicing other debts, it will be a barrier or it will be a challenge, you get. So the amounts you owe also has a big effect. Basically, some of the credit bureaus always say, always keep your debt ratio to 35% or 40% of your credit limit. You get, but irrespective of that, it's better to just keep your, especially for what we say, there are some good credits and bad credits. A mortgage loan is a good credit. A car loan is a good credit. A credit card loan, I won't say is a bad credit, but in sometimes those are one of the things that drastically affect your credit score, because why? They have limits attached to it, and the way people spend on credit cards can bring down your credit score or increase your credit score. Now, the length of your credit history also has a very, very crucial impact on your credit score. Most times they want to see how long you've been able to maintain this credit. You get, so for example, if you have a credit card, how long have you collected it? How long have you been maintaining it? That means at least if it's a year, 2 years, 3 years, the longer the better, the longer the higher score. So that's why I always advise some people. They'll say, "Oh, I don't want credit card. I don't want to deal with this." Fine, you can reduce the loan on your credit card. You can reduce your credit card debt, but don't cancel your credit card, because the age always matters. It's one of the things that drastically affects your credit score also. And also another thing that might affect your credit score is when you apply for additional credits. So for example, it works in two ways. If you apply for credit sparingly and you are giving, then that means a new lender will be able to judge that, okay, that means this person has been able to meet some specific conditions. That's why people are willing to give him additional credits. The other way that it might affect you in a negative way is that if you are always now asking for credits, for example, you go to Home Depot today, or you go to some stores today and you ask for credit, I want to buy this, I need it in credit. You go to another place and everybody is pulling from your credit score, They'll feel, oh, this guy is unsettled. Is everything is dependent on credits, you get. So it has a good effect and a bad effect. So sometimes sparingly, always apply for new credits. Maybe once in 6 months, just apply or just ask for additional credit. Or sometimes you might even go to some places, yes, can I have access to credit on this facility? It doesn't mean that you won't pay this thing, but it's helping you to build your credit score. But it's not that you should allow them to continue pulling out your credit score every time. That can affect your credit score, you get. And the last thing that basically affects your credit score is also the type of credit you have. So for example, somebody that has a house worth $1 million and is probably the mortgage on his house is left is 600,000. If I'm a lender that you just want to borrow 5,000, I know for a bank to give you 560,000, then obviously you have a good credit rating, you get. So most of them, they also look at the mix of your credits, you get, if you have good and genuine credits. But when you are owing different banks and credit cards, all your credit history is, all your mix of credit is just on credit cards or it's just on line of credits, you get. Those doesn't show responsibility, especially when you a certain time of age that you've used in this country, and they say, okay, so for all the time that you've been here, you have just been servicing credit cards, you've just been servicing loans, you are not even taking good credits, you are not even reinvesting your credits, you get. So, and that's some of the things that affects your credit limits, you get. So what's the value of a good credit score? As I said earlier on, the value of a good credit score helps you to be able to settle well in Canada right here. Because if you have a good credit score, you can have access to loans. And if you have access to loans, you can have access to mortgage. You can have access to buying high ticket assets. Another good thing about your credit score, especially in terms of people who has business, because the advantage of being a credit system in this country is that, let's say, for example, you want to start up your business. Fine, you can use part of your own savings as your capital. But because if you have a good credit score, you can also approach any financial institution that you have a business plan, you have a business idea, you get, and this is what I intend to do. This is what I intend to do. And a lot of them will first check your credit score, check your credit rating, look at how consistent you have been in this, and they'll be able to give you loans. And a whole lot of businesses here, almost 90%, are dependent on the credit system in Canada here. Even though you started with your own capital, it's also good to access additional funds to also help you in your investment. Another thing I advise some of my clients also is that sometimes you also need to look at the interest rates that some of the banks are giving you. For example, if you have a good credit score, a lot of people don't know this, that you can actually negotiate your interest rates. You get, with a good credit score, you can approach any financial institution and say, okay, fine, even though out there you are giving people 6% or 8% rate of return or interest rates, because of my credit standing, I should be able to get on a prime rate or a little bit above prime rate. Prime rate is what the government suggests that the minimum interest rate of lending, it might either be the mortgage prime rate or just the lending prime rate you get should be. So you might say, okay, I just need maybe 1% above the current prime rate, which might be 5% or 6%. So you can even use it to negotiate your interest rate down. And if you are using those credits to do investment, that means if your rate of return is higher than the interest you are paying, that makes more sense. If you look at history, a lot of people, the wealthy people over here, it's not because that they are using their own money to invest. A lot of them are using access of funds. For example, like a Donald Trump, what he does is just that he uses his properties as collateral to have access to credit because he has a good credit standing. And that's why a lot of banks you'll see that will always give them. Even back home in Nigeria, Dangote, I know for sure because when I was in Continental, I know a whole lot of his debt profile at that point in time. It's not that a lot of them don't have access to credit also. They also use the same things to invest. So understanding the value of your credit score is very essential when you're in Canada here because you need it. It's one of the vital tools as a new immigrant or somebody that is settling around here. You need to understand and build your credit score as fast as possible so that you can have access to a lot of things that you might not know, so that it doesn't push you into situations that say, oh, if I'd had this information before, I wouldn't have done this way. Because it's very easy to build your credit score and it goes high. But once it start coming down, it's always very difficult to build it back up. You get, because a little missed payment or a little default or a little check on the credit bureau can really have a bad impact on your credit score. And you won't want to find out, probably that's the time you need even some job offers too, they still ask you for your credit score because they want to see that, okay, this person that I'm employing, if you're like, most especially if it's a financial institution, you're in a key area, probably in treasury, they want to look at, okay, do you have good credit rating? It also by determining you get what you want to use the credits for at that point in time. You get. So a lot of people now ask the question, and this is what, man, do I need a credit card? Yes, you still need a credit card because some of us moving into this country, with the way things are even in Nigeria, a lot of us, a credit card is good because it can help you to stabilize, especially when you just come into country. You get, when you open your bank account, some of the banks will offer you credit card immediately. Accept it, but don't mismanage this credit cards, because if you mismanage this credit cards, it can put you into deep issue. Most of the times I always advise people, ensure that you can be able to pay off your debt. If the bank decides, okay, I don't need this credit card, you get, so that you have funds that can clear the credit card immediately. I'm not saying don't manage it. You can be paying the minimum balance, but make sure that you have funds that can clear out the credit card so that you don't just mismanage it. A lot of people here in Canada, because when they are not used to this system, they spend a lot on the credit card. They spend a lot on what they have on their credit card. And all these things impact your credit score, which you don't know, because they will always look at the balance at every other week. Most of these credit bureaus, they check in with your financial institution. How much is the value of debts that you have? How much is your credit score? How much is the limit that you have on this card? You get, so, but credit cards are very, very good and essential, but always be able to manage these credit cards very well. Okay. So as just to round up, what are the ways to build up a good credit standing? As I said earlier on, you can, to build up a good credit card, always, as a checklist, always check on your payment history. Always make sure you don't default on any payment. You get, always make sure you don't default on any payments, any of your bills, any of your committed payments. Always make sure you meet it. You can set reminders. You can do things that, okay, so that I know this is the time when it's due. Some other things that we do, some of the institutions also do auto deductions. You can put some of them on auto deduction so that you don't miss all those things. As I said earlier on, don't close any unused credit card accounts. You can pay down the credit card account, but leave it open. It's still helping you to build your credit score. It's still helping you to give you a good rating. Diversify your accounts. Make sure that you don't put your portfolio into one thing. As you are also diversifying your investment, diversify your credits also. Make sure that all your credits is not just credit cards. Access line of credits if you can. You get access some other kind of credits. Mortgage is a very, very good thing that builds up your credit card, your credit score. You get, if I know some of them might need approvals, but if you can, always try to challenge yourself to be able to get into that also. You get, apply for new credit cards sparingly, as I said earlier on, at intervals. You get, don't just say, okay, I don't want to be I'm outside the credit score, because if you don't do that, they will feel that, okay, a lot of people don't want to, they are not giving you credits because you don't have a good standing. That's why you're not applying, you get. So apply for it sparingly. Take advantage of those options also. And on the most important one is to keep your debt ratio very low. You get, that's very, very key. Don't ensure that your debt ratio is between that 35, 40, 50%. You get, even if you can try and make sure that you increase your limit so that your debt ratio is still within those limits. You get. So I think that's all. It's just a brief session, and thank you for attending. And if they have questions, okay, I throw it back to you.
Thank you so much, Oga Yinka. I've learned plenty today. Thank you for coming. Please, if you have any questions, you can unmute and ask your questions right now. But before anybody does that, let me ask mine. So,
Okay.
like, I was of the opinion that paying just the minimum on your credit card could actually affect your credit score. It was better to just clear it off at once. No.
So it's all depends. You get, the most important thing is your debt ratio. You get, okay. Paying back the minimum meets the requirements of the financial institution. But in terms of your credit score, paying back the minimum doesn't affect it, whether you pay back this thing. The only thing is that if you don't pay back the minimum, then your financial institution, if it's occurs maybe like once, twice, or 3 times, they might send it to the credit bureau that you have been missing payments. You get. But okay. what will seriously impact on your credit score is your debt ratio. So for example, if you have a $10,000 credit card and your debt ratio is 9,008, that means it's going to really affect your credit score. It's going to bring down your credit score. You get, there's a percentage which I can share on how each of these factors affect your credit score. You get. So it doesn't really mean that you must clear off everything. You get.
Okay. Okay.
So, you know, one of the things about here is that if you don't have credit, how would the banks make money?
Yeah, that's true.
You get, and they all work in tandem. You get. So one of the ways they also make money is the interest they're charging on those credits. You get. But keep your debt profile very low, and always make sure that at least what should be your high debt ratio should be like maybe your mortgage or even your line of credit, because the credit card, on the average is about 20-21%, or even stores that we know that is very, very high. But if it's line of credit, it's still about 6-7%. It depends on how you negotiate on the line of credit. So at least on those ones, you know that you are paying a minimal interest, you get, and you're still on the safer side.
Okay. Thank you so much. Samuel, you have your hands raised. You can unmute yourself, please.
Okay, hi, good evening, everyone. Thank you to the speaker for a wonderful section. I just wanted to ask, so I have a credit card, but when I maybe buy something, I just refund the money maybe the next day, the exact amount that I bought. Is that a good practice? That's one. And do they get to charge me interest on that? That's the first question. The second, and sometimes I get to have excess of the credit on my card. I don't know if that's a good practice. Secondly, is the issue of mortgage. How soon can one start applying for mortgage? Is it a year, 6 months, 2 years? And what's the minimum credit score does one need to before you can apply for that? Thank you.
Okay, so let me take the first question. So most times I know a lot of people, which is good practice, as you said, you buy from your credit card and you just pay back maybe immediately, which is okay. That attitude doesn't really have a big impact on your credit score because it depends on the long run how much you still have in balance on that credit. So for example, I know you are running down your credit score to the minimum, you get. So that means you don't have any balance on your credits, you get. The thing about it is that it might not boost your credit score, but it doesn't mean it will reduce your credit score. You get what I'm saying? So for example, let's say you're on the 650, your credit score is 650, but because of that attitude you get, it might not throw you into the 700s, or it might not throw you into the 720s, you get. Because one of the things why they always increase your credit limits is most of the time based on the age of that account and the credits that you owe on that account. So for example, if most banks, immediately you start up, they give you like 1,005, they change it to 3,000, 6 months time, they change it to 4,000. At some point they reach a limit and they now start looking at your credit history, your attitude towards credit. So if you are the ones that keep your balance at 0, they are not likely going to increase your credit limit further than that, you get.
Wow.
If you are somebody that, because in all honesty, they are not making money off you, because if there's no interest that they can charge on the balance, then they are not making any money off you, you get. The second question I think was, do you pay any interest if you still retain that habit, you get? So this is how it works. They charge you, it depends on the financial institution that you collected your credit. Some of them are outrightly, maybe like stores, some of them are from the banks, you get. And some of them charge you based on purchases on your credit card. So for example, if you did like $6,000 purchase on your credit card, you get, they will charge you interest on that, even though you have paid back the 6,000, but because you made that purchase, they charge you interest on that purchases, you get. Some, you just need to critically review your credit card statements. Some, they charge you on the balance at the end of that your billing cycle. How much is the balance at that point in time? And then they charge you the interest rate. But most of the financial institution charges based on the purchases. So you just need to review your credit card statement very well. They will charge you based on the, so even though you are paying back immediately, it's just as if you are just funding your credit card. Even though you are paying back to over your credits, that means your credit card is a negative, meaning it's in debit in the other way around. You get, they will still charge you even as a little interest. It might be minute, but it might not be something that you notice. Sometimes it might just be in the sense or listen. The third question is on mortgage, which is a very, very good question. You get, how long do I need to take to be able to apply for mortgage? So because of, there's a standard CMA, the Canada Mortgage CMHC, which regulates, there's a standard regulation every financial institution giving out mortgage loan must apply for. But they've given them levity to be able to assess each customer based on their profiling, you get. So I can tell you, some people can access mortgage in 1 month. Some people might not be able to access mortgage in 3 years. And why would I tell you? For example, if they profile you and they see that, okay, for example, like an international person that is just coming in, if you meet the 35%, most of those international people, they don't have credit score in this country, but they are able to pay 35% down payments, you get. That's one of most of the Indians and the Chinese do. So far they can meet that down payment, then they can buy off irrespective. But there are some other financial institutions that also want to minimize their risk level, you get, because it's not left for even the financial institution to approve you to give you the mortgage. there's something that they call about a mortgage underwriter. So because they also insure every mortgage, even whether it's 10, 20%, 30%, they will still insure it. So it depends on the person, the insurance company also insuring that mortgage. The underwriter can also say, oh, it's high risk, we might not be able to approve it. So it all depends. They will still profile you. You don't need to wait till 10, 6 months, 1 year, 2 years. Always speak to like a mortgage advisor or speak to a financial advisor. You get as fast as possible. What are the things I need to be able to do so that I can work towards getting into getting my house as fast as possible, or be able to access a mortgage. Some of them will ask you, okay, give me your credit history. How much down payment do you have? What is your profile? What are all those requirements? And they can look and say, okay, these are the things you need to work towards. And then, okay, in the next 6 months, we can put in a request for you. You get whether you will, maybe the bank will be able to accept this, or in the next 1 year, or you get, or even in the next 1 week, you get. So it's all depends. It depends on the profile on the person applying. I hope I answered the question.
Hi, Sam. Did your question, was it answered?
Yes, thank you. You did. You did. Thank you so much. Even though I'll probably ask some more questions later, but others can ask. Thank you.
Okay. Okay. So somebody had his hand. Okay, Lekan, please you can unmute.
Oh, okay. Thank you very much for organizing this session. You said something about like not spending more than 30%, 40%. New Year like 3 weeks ago, and I just got my credit card. So by 30%, if for example I have 1,000 CAD, by 30%, if maybe I buy something of like 15% and I refund it, like return everything to become 1,000.
Okay.
And maybe I use it again, maybe 20%, and I return it again. You know, like accumulatively, it's more than 30%. But at the point is not more than 30%. So I would like to clarify that.
Okay, good question, Lekon. So when I talked about your debt ratio, I didn't really mean on just one card alone. You get, so it doesn't really fine. I know you just came in, and that might be the first access to your credit, to 1,000. So even if you spend $800 on it, you have spent 80%. It's not going to negatively impact on your credit score, because one, the age of your account is even very fresh, and they know most of the people that just come in, they rely on credit to at least to sustain themselves and to be able to balance. You get, so but at some point when you settle down into the industry, so for example, let's say you have a car loan that you want to, because you just want to get a car, you try to finance your car, and they will also offer you'll be building your credit history. Always keep your debt profile low. You get, so debt profile, what I mean is the totality of all your credits. You get, not just on one card alone, just okay because it's a fresh card holder. No, not that. Those will not really negatively impact, especially for a new account like that. But for example, for an existing account, you get, or probably someone that has used a year or 2 years maintaining credit cards in the system, and you are owing up to 8,000 or 16,000, your limit is just 20,000. That means your debt ratio is high at that point in time. But the good thing why I said keep unused cards is that they will look at the totality of your credit limits. So for example, let's say you have 5 credit cards from different institutions. One is 10,000, one is 20, one is 20, 20, 20, 20. You get, and some of them you have not even spent anything, you kept it blank. But on one, you spend the whole 20K. It still will not affect it, because if you look at the ratio, you are still within that 30% or 40%. You get.
Okay. Okay. Thank you so much.
I have a question here on the chat. Okay, I think you answered it already. Is it okay to pay off all the credit card debt each month? You answered that already, right? Doesn't affect or boost your score in any way if you pay it off.
Yeah, it's fine. It's a good habit to clear your debt, and you don't want to keep unnecessary, especially all those minus one. You don't want to keep unnecessary credit card debt. You get, if it's going to have a big impact, especially sometimes most especially some, maybe like you have, like I have a Leon card, maybe I have $200 debt on it. Sometimes I might even forget that I have that debt in that card because it doesn't, you get, and those missed payments can really affect. So like those ones, you can clear it off. But when I'm saying good credit, maybe like your line of credits, you don't necessarily need to clear off those. And your credit cards also, even if you are owing maybe 5,000, 6,000, you can reduce it at least to a minimum level where you can easily pay off if it requires you to pay off. Because there are some times where, as if you want to apply for a mortgage, they'll tell you, okay, go and clear all these debts. Even though you've met the other requirements, go and clear up this debt. You now need to start sourcing for funds to be able to clear those debts. You get, so it's just to look at it holistically. If it's going to be a big impact, then clear it off, fine. But if it's not going to be a big impact, there's something that you can be servicing monthly, then leave it, no problem. You can use your additional cash to invest in something else.
Okay. So the other question here, I really don't understand it, but I think the person mixed it up. Said, please, I would like to ask that how soon, when I move to Canada, can I apply for a mortgage credit card? I think there are two different things. Applying for mortgage is different and applying for a credit card is different, right? And I think you answered about the mortgage part. A credit card, you can apply immediately. You open your account. Most banks will give you a credit card immediately. Right, Oga Yinka, please correct me if I'm wrong.
Yes, most of the banks, CIBC, see this sometimes. Most of them will always give you credit card. I think it's only RBC that will still hold on for a while. You get, but it's not that they won't even still give you. They will still give you on the long run. So it's getting credit card it's good habits you get, but I don't think you really need a big criteria before you can access those credit cards.
Okay, so the another question is, so would I get both a credit card and a debit card? Then what expenses should be on the credit card and what should be on the debit card? Confused about the cards.
Okay, good question. So naturally, when you open every account, they'll give you a debit card. That's standard. Some of the financial institutions will give you a credit card also. Most times, your recurrent bills is always advised to put it on the credit card. You get, because one of the reasons why is that, for example, there's always money in the credit card, you get, so that you don't miss payments. You get, so that, for example, if you're running on a debit card and there's money, and if you are supposed to pay like a bill, it can return back, because if they don't have access to cash in it, then it will return back. Because so a lot of people always put their recurrent bills, probably their hydro bills, their internet bills, all of those on credit cards. And there are sometimes you might need to go to a store and impulse buying. That's what kills a lot of people, the impulse buying, because they just use the credit card immediately. You get, so what is, I can't really say what is the best service to put on a credit card you get, because it all depends on your spending habits you get. The main thing is able to make sure that credit card, you'll be able to manage it, irrespective of whatever you're spending on the credit card, you get, be able to manage it, you get. Some of the banks will always give you, oh, there's cash back, you get 1%, 2%, you get cash back on when you spend on credit card. But just take a look at it. Always look at how much interest rate is the bank charging you. 20%, 21%, 22%. Stores are like 28%, 25%, 27%. 27% interest rate is in 3 or 4 years. That means you are owing everything you get. So just be able to manage it. Don't excessively use your credit card. If you have money in your debit card, you can spend on your debit card. But there are some situations that will warrant that you just need to use the credit card at that point in time.
Okay, so when you're new and you want to build your credit score, it's good to use your credit card just to keep building your credit score and pay back immediately.
Yes.
Okay.
Use your credit card so that they can also increase your credit limits also.
Okay.
Always use your credit card, because if you don't use the credit card, they won't increase the limits. You get. So
Okay.
use it. You can be paying back, but servicing it at every point in time, or even maybe leave $1,000 as debt in it, or just make sure that you at least are using it so that it's functioning, and it will help you build your credit score.
Okay. There's another question that said, what happens if you can't view your credit score with Equifax or TransUnion? I have had an account with a Canadian bank since 2017. but only moved here and got a SIN in April of 2022?
Okay, so that's two questions. I think so. So for Equifax, most of the time you can log in. I think there's a paid service for TransUnion. To access your credit score is free of charge if you are using TransUnion. There are other subsidiaries that work with TransUnion and Equifax so that you can also access your credit score free of charge. And there are some banking apps also so that if you log into your bank, they can say, okay, check your credit score. So most of those ones might not be as updated as possible. But Equifax, most financial institutions here rely on Equifax. They believe Equifax is much more reliable. You get. So even if you can't access your Equifax accounts, there's a paid service for you to pay $10 or $20 a month, I think so, to be able to access your Equifax. There's also the free of charge. They can send it and email it to you directly. So just visit their website, register, and then you can access your credit score. You get. So far, the only issue sometimes is if they can't verify or they can't tie you, because most financial institutions report based on your address, your name, and then your SIN. You get. So except if you have any issues, probably you've changed address, or your name, you've changed name, or probably you've changed SIN also. Those might be the issues warranting why they can't access your credit score immediately. Give their customer service a call. Most of the time, they'll be able to help you resolve it. You get.
Thank you.
So I think the second question was on, I've had an account since 2017.
Yeah, she mentioned 2017, sorry. I've had an account with a Canadian bank since 2017, but only just moved here and got a SIN in April 2022.
So your credit score will just start from the time you just moved, April 2022.
Oh, okay.
Because that's when you just had a SIN.
Okay, even though she had an account in 2017. Okay.
They won't be able to, even if they are reporting, they won't be able to rate her because they have to tie it back to your SIN.
Your SIN. Okay, okay. That makes sense. Blake, do you have your hands? Okay, no, you've brought it down. What about Samuel? Do you have your hands up, or this was from your earlier question?
Okay, so the question basically is about car loans and then credit score. Okay, so if one, how does one link it? You know, do you go to the bank or do you do car dealership? That's one. The number two, if you just have for example, have a credit card, right? And I within what I do, and I've already got into maybe like 500 and something, maybe fair. All right, can I begin to use that to do my recurring bills? And how do I use my credit card to pay recurring bills like utility, NEPA, and all those things?
Okay.
I said that's in NEPA. Sorry, there's no NEPA.
No, don't worry,
Yeah,
we all understand. Okay, so the first question is about car loans. Most times when you approach a dealership, most of those dealerships already have links with all the financial institutions you get, or most of the financial, at least every dealer will have with one. They either CIBC, they have with RBC or someone, or you yourself can actually approach your bank directly. You get, if you have a good, maybe like an advisor within the bank, and it can help you access car loans. But most of the time, most people just rely on the dealership because the dealership can actually get better deals or better interest or fast approvals, you get, rather than you just approaching them directly. You get. In terms of credit score, so for example, let's say you have 560. So every lending institution has its own criteria. You get. I can tell you, for example, so I've seen somebody with 600 or 700 score and they didn't approve him for mortgage. And I've seen somebody with 580 and they approved him for mortgage. You get. Because it might not, the credit score is one of the factors that they can use to, is one of those criteria they use to assess. But I said the main thing about giving out this thing is still the profiling of the customer, you get. And my credit score might be bad, but I might have very, very good investment, which I can tie as collateral, you get, so that I can assure them that I can pay, you get. So the underwriter looks at a holistic situation, not just on the credit score alone, but it's one of the important factors you get that they use to determine, one, whether they will give you the loan, two, also the interest rate that they might charge you on irrespective of every loan that you're collecting, you get. So that one on the credit score. So I think your third question was on how do you now tie in some of your recurrent expenses to your credits, to your credit card. So most of all this, I think 99% of all our utility bills or you can log into your account and either put a recurring payment you get on your credit card. So they will ask you to put your details in it, and you can preset it so that it comes like an auto deduction from your account or from your credit card immediately. You get, so that you don't miss any payments. You get, and if you are the one that you just wish to pay it, maybe when you see the bill, then you pay it. You get, that means likely you might need to go into the accounts you get to also pay. Some bank apps allow you to make payments, pay bills from your credit card directly. Some might not allow you. I'm not too sure. I don't want to say all of them will allow you, because some might not allow you. It might be restrictive. If you log into your banking application and you register the utility provider, you can be able to pay those bills also from your credit card directly.
Thank you, Oga. The next question is, what does a line of credit mean?
Okay. So we have, every financial institution markets a line of credit in different ways. Sometimes they might sell you home buyer's plan, they might call it different ways. A line of credit is just simple. It's simple thing that you're just getting a loan. But unlike a loan, they are giving you the money upfront. You get, for example, in Nigeria, what we understand is that I apply for 500,000 naira loan and they give me 500,000 naira and I need to pay back. But a line of credit means that they are giving you access to credits of that amount. It doesn't mean you must take out everything you get. So you can get approved for a $200,000 line of credit, meaning that you have access to cash out 200,000 when you need it from the bank. But some people might say, fine, you approve me for 200,000, I just need 10,000 or 20,000, you get, and they only use that 20,000. Most times, the line of credit, the interest rate on the line of credit is always lower than any other, than your credit cards you get. Is a lower interest rate. It might not be as low as mortgage, but it's always a low interest rate. Number three, again, the difference between the line of credit and basically the credit card is that on the line of credit, you must pay back the interest. So they will charge you the interest based on the balance as at your billing. So for example, let's say you have an interest rate of 5% and you are owing $10,000. They will take out that interest rate. You can keep your $10,000 as line of credit for how long you want it, but they will charge you that interest. So it doesn't increase, you get. So you're only owing that 10,000 because they will be taking out the interest every month, or it depends on how the contract you sign. It might be quarterly, it might be annually, but most of the line of credits are monthly, so they will take out the interest. So your debt will still remain constant. For example, it'll still be that 10,000 you're owing every month. So any interest at the end of the month, they will charge you, and you must pay back that interest. Unlike a credit card, let's say you are owing 5,000 and they charge interest of another 200, they will add the 200 to the 5,000. That means the next month you're owing 5,000 too. If you don't still pay anything out of that 5,000, so it keeps on growing. But the line of credit will not grow. Whatever you take out of the account, you must pay the interest on that, and that's your debt.
Okay, so if I have a $10,000 line of credit, it doesn't particularly mean that I will be paying interest. There's no. Okay, let me get the question.
You're only paying interest on whatever you withdraw from
whatever I use.
Yes.
Okay, so if I don't use it at all, I don't pay any interest on it. It can just be there until whenever I need to use it.
Exactly.
Okay. How soon can I apply for a car loan as a newcomer?
Wow. Okay. It all depends. So for example, when you're applying for a car loan, one of the factors that they might consider is how much down payment that you are willing to pay. So for example, if you are going for a car that is about $30,000 and you're paying 2,000 down payment or no down payment, you get, it might be more difficult because you are new in country for them to approve you, you get. But let's say, for example, you are paying a high down payment and then the risk is, because everything is still on the right, everybody, they'll still look at the profile and the risk. What the lending institution is looking at the risk for you to pay that back. So you might come into country, you might be a doctor, you might have a good job and a good paying job, and they know that fine, you can meet even this obligation. They can give you immediately. So it's case by case basis. You get, most times just approach the dealer and see whether you can get approved. And as I said earlier, most of the dealers have fantastic relationships with the financial institution. So you might be able to get it even as fast as possible.
Okay, Sam, you asked what's the site where we can check the credit score. You mentioned it, Equifax and TransUnion, right?
Yes.
And I think your banks too, like for me, Scotia Bank, I can actually check my credit score on my banking app. So if you have an account, check with your bank if you can check also. So this is the next, leading to the next question. Is it true that it's if you make inquiries about your credit score or something, it would affect your credit score negatively?
Okay, so the hit on your credit score. So there's what they call the soft check and then the hard check in checking the. So the soft check is meaning that, okay, fine, you're just checking to know what your credit score is, or maybe an institution is just checking to know what your credit score is. The hard check is probably you are applying for a credit facility and they need full information on your credit history. You get. So for example, let's say you want to collect a mortgage or you want to buy a car. Most of those credit checks are hard checks. You get. If you are just checking just to be aware, or maybe like you are in a store and they want to give you credit card and they say, okay, give me your distance. Sometimes those are just soft checks. The impact of soft check is not as harsh on your credit score as the impact of a hard check. But, and I'll give you another scenario. So as I said earlier on, everything has a rating. It doesn't mean that even though you're checking your credit score is negatively affecting your credit score. You get what I'm saying? Because it's always good to be aware. It's always good to know what your credit score is at every point in time. You get. So most times soft checks doesn't have a big impact. You get. It doesn't mean that you start checking your credit score every day, because the score doesn't take every day. You get. But at least at intervals in a week, 2 weeks, you can be periodically checking it. It doesn't have an impact. But let's say you're now approaching institutions all the time. So maybe like in this month, you approach 3 places. You went to one institution that you want to access credit, another place, you get, all those ones will negatively affect, because that means you are living your life based on credit at that point in time. You get.
Okay, for me, my bank, I think I check every month because it updates every month. So it's not as, like you mentioned, it's not as current as what you get from Equifax, but every month it updates. So I'm able to know my credit score every month. Okay, yeah, Sam, Olayinka is going to drop his contact details for people that want to contact him. Sam is asking how can they contact you. So he's going to drop his contact details by the end of the meeting today. Then on average, how many points do they deduct on a hard check? Is there any like standardized points they deduct if you do a hard check?
Okay. It's not standardized. It might, even if they do a hard check, it doesn't necessarily mean it will affect your credit score. Sometimes it can even boost your credit score. You get, because it depends, as I said. Also, if doing a check on your credit, meaning that at least you are trying to improve your credit score, you're trying to access a credit facility, it might not. But for example, if you are now doing a hard check every time, maybe like 3 times in a month, I told you there's a ratio. I think it's 35-30. Every of these factors has ratio in which like Equifax uses to rate your credit score. It's an algorithm. So it doesn't mean only on checks alone that affects your credit score. The ones that are high is your payment ratio. You get, those are the ones that your debt ratio, your payment ratio, those are the high ones. For like all those checks are like 10%. It doesn't negatively or really have a big impact on your credit score like that. I think you're on mute.
Oh, sorry. Yeah, is there any other question? Is there anybody that wants to ask any other thing? No hands raised. And that is like the last question on the chat box. So Minka, please, I don't know if you can give your contact details. Just put it in the chat box here.
Yes.
And people can reach out to you. Anybody that wants his details can grab it from there.